Good day, everyone, and welcome to the Bramsol webinar series. My name is Julio Dallacosta, and I'm the Director of Technical Accounting at Bramsol, and will also be one of your hosts and presenter for today's webinar. Today, we'll be talking all about Treasury. Okay. Can everybody see my screen now?
Yep.
Perfect. So unfortunately, John Froelich, who is our normal host, will not be joining us for this webinar. John actually is in flight right now, so he will not be able to join us today, but we wish him a safe flight back home. Today, we'll be talking all about Treasury. First of all, let me thank all of you who have taken time out of your busy schedule to come and spend an hour with us. We are truly appreciative of that, and in return, our goal is to deliver both informative and focused content to you. On the call today from Bramsol, in addition to myself, we have Sarah Thompson, Senior Solutions Engineer, who will be giving us a short treasury and cash management demo, and also Steve Stone, Director of Professional Services at Bramsol, who will be giving us some additional insight in one of the treasury projects that Bramsol is currently engaged on. We are also very fortunate to have Harish Chaya from SAP, who is the Director of Solutions Management in the Treasury and Risk area. Harish is a seasoned executive and has proven track record of leading a variety of complex global initiatives which have delivered significant business outcomes. He has also helped several Fortune 500 companies through their financial transformation journeys. He is clearly an expert in the development and delivery of enterprise business technologies that support intelligent treasury operations. He is also a subject matter expert in treasury and risk management, including cash and liquidity management, FX, commodity risk management, payments and bank communication, in-house banking, accounts receivable, accounts payable, and general ledger accounting. We're very happy to have Harish. Welcome.
Thank you.
Some housekeeping items to remember. The webinar is being recorded, so you can download and play back to your teams who were not able to make it today at a later time. Feel free to ask questions in the box shown on the screen. Also, please note that you can go to our website, bramsol.com, and download previous webinars, including content on revenue recognition, lease accounting, S4, and the transformation journey and other SAP development initiatives. You can also download from previous webinars on our website, bramsol.com. As you can see, we have some very focused content on our website. I personally especially like the one titled RevRec is Dead, Now What? As it tells you all about the RevRec journey. Go check it out, and I think you'll enjoy it as well. Quick reminder, in addition, you can find us on a number of social media platforms, including Facebook and LinkedIn. We also wanted to let you know that Bramsol will be at SAP-centric and Bioanalytics conferences, 2 events in one, in Dallas from March 11th to March 13th at a beautiful Westin Dallas Park Hotel. Register now and save an exclusive Bramsol discount. Give the code BRAMWEB. It promises to provide a great event with great speakers and content. And actually, 1 week later, Bramsol will also be at SAP Insider in Las Vegas, where we'll be hosting a number of workshops and sessions. Make sure to stop by and say hi if you decide to attend. Before we get into the agenda for Treasury, for those of you who have joined us for the first time, let me spend 1 minute to introduce you to Bramsol. Bramsol is a niche player in the Office of the CFO and provides solutions focused on addressing some of the most challenging issues facing the CFO organization today. Over the last 5 years, Bramsol has been laser focused on providing compliance solutions for the 2 most complex accounting changes in the last 50 years, namely revenue recognition and lease accounting. Many of our customers have been repeat customers in the sense that we help them first with complying with the complex changes in revenue recognition, and then in turn, we will call in to assist with their lease accounting adoption. With Bramisol earning the status of trusted advisor within these organizations, and after assisting companies to navigate the hows and whys for the inflows of funds into the organization, namely revenue recognition, and then being called in to assist helping those companies navigate one of the largest outflows of funds of the organization, namely lease and asset accounting, it was a natural evolution for us to be called in for another complex area within the office of the CFO, namely Treasury, and how to properly manage and give more visibility to those inflows and outflows of funds, and more importantly, what to do with those funds once they are within the organization. Today, we're going to give an overview of the Treasury function. We're going to start with that overview. Then we're going to talk a little bit about cash management, a little bit about cash forecasting. Then we're fortunate enough that Sarah Thompson will give us an overview of the Treasury Demo within SAP. Then we'll talk a little bit about, we have a current project undergoing right now at Bramisol on Treasury. Then we'll talk a little bit about debt management, covenant compliance, and some risk management activities. We'll also talk about derivative transaction risk as well. Then we'll be fortunate enough to be joined by Haresh, who will give us an overview of the SAP Treasury solutions within the SAP space. So what is an overview of the Treasury function? Well, the first thing we have to make sure is that Treasury is a critical function in every organization and focuses on the process of administration of a company's financial assets. The goal of most Treasury management departments is really to optimize their company's liquidity, make sound financial investments for the future with any excess cash, and reduce or enter into hedges against its financial risk. So the first thing, obviously, is to make sure that the right amount of cash is in the right accounts on a daily basis. Companies today are laser focused on working capital management. So this is the day-to-day cash management, ensuring that funds are available to meet business needs, not actually making payments to vendors. Secondly, it's working with senior management to set financial strategy related to capital structure and then executing that strategy. So what is the optimal debt to capital ratio? What are the leverage ratios ideal for your industry? And also, too, more importantly, knowing the cost and benefits of an investment grade rating and managing communications with each of these rating agencies. Another overview really is the managing the interest rate, foreign currency, and commodity risk. These are risks inherent in the business, especially for multinational environments, and determining how these risks should be mitigated. Lastly, is really maintaining strong working relationships with a bank group and leveraging the expertise to execute financial objectives. So if we talk about the overall cash management activities, what are they? Well, the first and foremost, you perform daily cash settlement activities. What does that entail? That entails monitoring your cash balances to ensure you have adequate liquidity, monitor daily cash inflows and outflows, and compare activities to forecast, and also to review and approve all wire transfers. What does that look like from your bank account information? Well, you manage your bank accounts by having a centralized administration of all account maintenance activities, and you maintain and monitor your listing of accounts and related authorized signers. You also manage your short-term investments. How do you do that? Well, if you have excess cash on your banks, you would invest that excess cash on a daily basis, usually through a sweep function, and then you would assess the different investment alternatives, whether it be short-term or long-term, and recommend an investment strategy. So what is the risk? A critical risk is the failure to effectively manage cash and investments. That can really mean that the company is not able to meet demands on a timely basis. So nobody wants to get to work and then you miss the payroll. So, your employees are depending that every day they can trust that the company will have the cash required to fund their paychecks. What about your vendors as well? Vendor deliver tools, equipment needed to serve customers because they trust that the companies will pay invoices when they are due. Well, how do you mitigate that risk? Normally, large companies and small companies, all the same, they would establish a predefined target level for cash on hand, forecast cash needs for both recurring and non-recurring activities, and ensure that your credit lines are maintained. I think right now, a lot of companies have been targeting not just revenue targets, but also working capital targets. It's very important because you have to know when your monies are going to arrive in your company and when they're going to leave and what happens in between. So it's very important to understand the relationships between your cash inflows and your cash outflows. So what are some of the compliance approaches? Well, obviously from a senior leadership perspective or your board of directors, there's usually a defined target cash balance and you have to comply with that. Companies are very strict on that because you have some companies have debt management as well as your daily cash management as well. You would also want to review forecasts and assess whether the established targets are adequate to cover your daily cash needs. And lastly, and probably one of the more important ones, is you always want to ensure you have credit compliance with your credit agreements and ensure that the authority for accessing credit lines is delegated, proper segregation of duties to ensure a good balance between safeguarding of assets and flexibility to manage the business. Another very important risk here is the lack of proper safeguards to a company's cash. This can result in a misappropriation of funds. And as we know, Treasury is not the only part of the organization that needs access to companies' cash. From a risk mitigation perspective, what we see is segregation of duties is the key. The person who is signing off on the approval shouldn't be the person who's releasing that funds. From a risk mitigation perspective, you would want to have a limited number of authorized signers, as well as the limitations to user rights. So it's typical to restrict non-Treasury personnel to deposits and report reviews only. You would have a strong forecasting group as well as strong controls over operating disbursements. Some of the compliance approaches would be, I would review the established processes and controls looking for the following. Is there adequate controls over account setup, vendor setup, and wire template processes? Are there non-recurring payments that must be processed by one person but released by another? This is segregation of duties in effect. Lastly, it's all about ensuring that my forecasts are complied at a detailed enough level to ensure that variances in particular disbursement categories are easily identifiable. I wanted to bring in an example from my personal experience. At one time in my career, I was an internal auditor, and one of my projects was to investigate the CEO of a European subsidiary in the United States. He was essentially paying for his kids' college tuition via expense reports. True story, it actually resulted in him being fired, obviously, and prosecuted by the police. But the essential lesson here is proper safeguards will ensure that your cash is not misappropriated. It's a very important step. Another related risk is really the accounting and reporting rules related to cash investments. There's differences between cash equivalents, and investments. There's also differences between investments and available for sale securities. So you have to make sure that you're in accordance with the accounting regulations as well. Fair value disclosure requirements that companies be able to separately identify and quantify cash equivalents, and investments. There are countless options for Treasury, including cash equivalents. The cash equivalents refer to bank accounts, marketable securities, commercial paper, Treasury bills that have a maturity date of 3 months or less. So how would you mitigate that risk? Obviously, you have to have proper communication between Treasury, accounting, and the folks who are doing the reporting. But more importantly, you would want to have a proper investment policy that's going to limit your treasury's investment alternatives. In my experience, I've seen companies that would have investment policies that would prohibit anything besides cash flow hedges. So there's no trading of securities for profit-making positions. So what's a good compliance approach? You always want to ensure that you're confirming your various cash and investment balances. Confirming is you actually reach out to the bank independently of the company to ensure that the balances that are being reported are the ones that are being captured. You also want to make sure that your reporting teams are obtaining the documentation to support periodic disclosures. There's nothing better than a good disclosure report from the bank directly rather than your GL system. You also want to inquire about your organization's investment processes, particularly considering how frequent does the investment approach change? What are the authorizations required before a Treasury Department can pursue different investment alternatives? We always like to say documentation is the key in this exercise. Now I'll turn it over to Steve Stone, who's our Director of Professional Services at Bramisol. Currently, we have a large project where Bramisol has a Treasury-focused engagement. So Steve, why don't you give the audience some details about this project?
Thank you, Julio. And just thinking about the risk and the mitigation steps there, just kind of I think of two perspectives. And we kind of have two requirements. Both are global in operation in terms of the companies. One has centralized on a vendor, an external bank vendor that they're working with, and they run all processes through that vendor. So pretty simplistic model, and one that they can focus on, and one that they can manage pretty much in control. On the other end is this client, who is also global in nature, who is looking at a merger and acquisition with an equal size, if not larger company, who has its own policy and practices. And they, because of where they operate and because of the type of operations and the local relationships, they want to have the flexibility to work with vendors around the, banking vendors around the world. They also would like the visibility to see these transactions, to have them visible to both organizations as they merge and come together in terms of their processes and integrate practices, both from a technical standpoint, but also from a financial and a treasury point of view and practices. And then, basically empower those different organizations and localities to act in a discipline and I would say managed behavior, so that they have the visibility throughout the organization for audit, for day-to-day quality control, and to your point on many of these mitigation steps to make sure that they're active there. So we are in the process of this with this client, working region by region and basically releasing I won't say global template, but a regional template in how they interact between the organizations and with third-party banks, and how we are providing both visibility to automated transactions, but also control mechanisms for managing that both across vendors as well as internal to the organization at multiple levels. So, if we look at the two pieces on the or two markers on the spectrum here, that's really as organizations look at this and say, who's involved? Is this just a treasury exercise? It's really not. It can go back into other areas, and in fact, both of these organizations are considering the SAP S/4 migration from the current ECC ERPs. So that's another element that they're basically getting their houses in order from a treasury standpoint before they embark on these longer journeys to take a look at their fundamental core business operations.
Thank you, Steve. Steve, I wanted to bring in now Haresh from SAP. Haresh, from your perspective, what are some of the projects that you see, especially in the cash management area?
Sure. Just talking in the context of this project, a lot of large companies have a large number of bank accounts that they need to manage, and the whole management process becomes even more critical at the time of mergers or acquisitions. Banks really need to rationalize the bank accounts that are existing in their landscape, they need to evaluate what cash flows are going through each one of these bank accounts, and then once they have rationalized the bank accounts, they have to be able to transfer them to their platform. In this case, I assume S/4HANA platform, and that takes navigation through a variety of steps. They need to make sure that the key attributes that exist in their legacy systems are captured, signatories are correctly defined, overdraft limits are defined, and then they need to set up these accounts for processing through their banks, which means they need to be able to exchange transactions for this account in an automatic way through some sort of bank connectivity solution. All of these processes are very vital for anybody to start rolling these new accounts into a cash management process. And we see this now and again, that many companies struggle with this process, and they look for solutions that simplify this whole transition. Being from SAP, I could be a little biased, but I would be happy to mention this to everybody, that SAP has bank account management solution that offers some of these capabilities to make customers' lives easier.
Thank you very much, Haresh. And Steve, I just have one more question for you on the project. So the end state of the project is essentially what? You're going to map all these different bank accounts to the parent's ERP system?
So yes, it is in phases, and as I said, it is connected to a broader ERP transformation. But currently, it's getting control and rationalizing, as was mentioned there, between their external vendors, looking country by country,
right.
Looking at the cash flow across those countries and the relationships and business operations with the banks. Creating that triangle between the two entities that are merging, as well as their external vendors that are now rationalized, and then automating those processes with the appropriate controls, the visibility on the daily basis, but also from both a local level, but also in a consolidated manner, so they can manage the risk and put in mitigation steps where necessary. And also, as the organizations merge, they're evaluating their policies. I don't think either organization is looking to be the successor. I think they're looking at basically pulling in and aligning their operations to meet new needs that are around the corner from a business model standpoint.
Thank you very much, Steve. And actually, that takes us nicely into a Treasury demo. It's going to be performed by our Senior Solutions Engineer, Sarah Thompson. Sarah, take it over.
Yep. Thank you, Julio. Julio, will you let me know when you can see my screen?
I can see your screen.
Perfect. All right. So what I would like to go through with everyone today is a little bit around kind of what Julio and Steve and Haresh have already talked about. So if we're talking about cash management, I want to start with a topic around performing and managing within your bank accounts, being able to see that workflow, how you're able to mitigate on that risk while deviating the workflow between multiple people, as well as going through cash management, being able to see your cash position, the liquidity that you have at any point in time, as well as approving payments, transfers between the different bank accounts. So if we start here on our bank management, we'll be able to see that you're able to create multiple workflows. So this would be done by an administrator usually, but you're able to set up workflows for different things within the system. This is really important within bank management because you're going to want to have multiple types of workflows that are out there. So if I come in, right now I've got 2 steps for approvals for anything that takes place within a certain company code. I can see the different step sequence if there was a change to any of my bank accounts within that company code, as well as the process request for changing those across all of the bank accounts. So those can hit multiple people. You can see set up who the recipients are. It can also tie back into HR if you guys want to do headcounts for how you're setting that up. What that manages is all the workflows for takes place of anything that we do within the system. So if I come in to manage all of our bank accounts, you'll notice there are multiple fields here. And for those of you who are familiar with SAP, you'll notice there's all these different fields, as well as the ability to kind of add in any fields that you might be searching as well. So these can kind of all be updated, but these are delivered out of the box. We can search across our company codes. So I want to look at the company codes that we have our workflow set up for. And I can search all of the managed bank accounts for that particular company code. So we'll see here is we might have 23 just for this particular company code. They have hundreds for the company worldwide, but I can go back down now and see all of the different company codes, or all of the banks that I have for this particular company code. You can set up lock boxes, you can set up different bank accounts within a certain bank. So we can see here we've got multiple accounts at Wells Fargo, and I can actually drill in from here and see all of my bank details. So depending on the authorization that I have, you could only have read-only rights. You could have the ability to go in and make changes to bank accounts given the correct approvals and authorizations. So from here, I can actually make edits on our bank account. So for example, if need be, maybe when we first set up our bank account for this particular one, we've got it under a certain company code. We've got all our controlling areas set up. Well, let's say when we set up this bank account, we made an overdraft limit of $200,000, but we actually think that based off of what we've seen, we actually want to kind of bump that up a little bit. So let's say we want to bump it to $300,000. So we can go ahead and make changes within the system, but my only option here is going to be submitting that for approval. So no one can just come in, make changes to certain bank accounts based off of what they have, but they're actually going to have to submit that for approval for someone else to go in and approve that our overdraft limit is now going to be that $300,000.
So Sarah, if I could just interrupt you really quickly. So what you're showing there is proper segregation of duties. The person who is accessing the transaction, you're having somebody different actually process the transaction.
That is correct.
Perfect. And that actually will maintain, under Sarbanes-Oxley, proper segregation of duties controls.
So I'll actually submit this for approval. What we'll be able to see is that I'm going to have to log out and log back in as another user to be able to approve on this account. So this account is actually going to, number one, say that someone has changed it, and then it's going to be able to send that to the user that's actually out there. So you guys can set up different workflows how you want it. Right now I'm logged in as John Morris. I'm going to sign out and log in as another user. And the workflows can be set up, so if you would like to see it as an email that gets notified, or we can also see, we're going to notice that there's a notification tab that allows for you to view all of the notifications and all the approvals that come through. It's really up to the customer on how you guys want to set that up. So I can first
Sarah,
come in.
can you do workflow? So basically it comes to my inbox for approval, and I can click on that link and go directly into SAP and approve the request?
Correct. Yeah, I can go directly into Outlook. You can come in here. There's different tiles you can set up so I can see my inbox. But you also notice when I logged in as this other user, Paul, I now have a +1 over here as a notification that says, hey, you've got some approvals that are out there. I could just go ahead and approve these here. Or again, I can always come in, take a look at my inbox if I want to know more detail rather than maybe just, quick approving. If you're the same users that are constantly doing stuff, you just want to approve it, you can do that from there. Or you can say, oh, someone came in and made changes to the bank account. Maybe I want to go into the bank account and see the history. What is the change that was made? I can view that there. You can forward this to someone else, approve or reject, like anything within a workflow, make a claim or suspend this account until I do some further investigation. You can also show a log. So if you wanted to send any information here, a task log, a workflow log, you can see what any of those changes are that are made. And then all we have to do is go ahead and approve and say it's been approved. send notes back and forth, and then that's all going to be captured in the history. So anything that's documented within the system always stays within that certain bank account. So not only is it segregation of duties, but there's also a complete audit log for any changes that take place on any of your accounts. All right, so I'm going to go back and sign in as my original user, and then we can go through and take a look at our cash position. So as we're going through and taking a look, you can manage the different bank accounts. You can take a look at all the different bank accounts that you have, make updates. You can also look at the cash position for all of your bank accounts. So if we come in, this is going to give us a holistic view of all of our accounts across all of our different countries. So we can see here we've got 4 countries that we're working in: the US, Germany, Australia, and the UK. I can actually drill in to one particular area of this, and I've got the ability to drill down. So one of the great things about SAP and about specifically within Treasury, there are a lot of different analytical views or analytical tiles that kind of give us a holistic view of our cash position or our treasury, our liquidity within the company. But it always allows for us to drill into the further details. So in particular, if I'm looking at the US, I can actually go in and take a look at each individual bank that I have and see kind of where my money lies. So my Bank of America is really where I keep everything. But let's say we make, monthly or quarterly bonus payments out of our Citibank. Well, we're going to need to transfer some of those funds. You can always do that by continuing to drill down. So let's take a look at what our cash flow actually looks like for our particular bank by, again, drilling down, not having to go back and leave that screen that we were in. And we're going from an analytical view actually into transactional information. So I can see here what I'm looking at. Let's actually look at this in US dollar. We can compare all of our company code currencies to our group currency if we were looking at USD. I can actually drill down into my particular company code and see all of my accounts within this particular bank. So within Bank of America, I've got 4 different accounts out there in the US. As I continue to drill down, I can actually see what that cash position is. So what's coming in, what's going out, what is overdue as of today, and then what is my balance going forward. So I can see, you can set up how many days in advance you want to see. So this is looking at a week, and then we're getting into the future payment. We can actually drill down again from here and make additional transactions. So all the screens continue to drill down. You can check actual cash flow items. You can make bank transfers. Like I said, we actually want to move some of our funds into the other bank so that we can make our monthly or quarterly bonus payments. And now we're taking all of our information from one particular place and saying, okay, well, this is the bank account we were just looking at. What funds do we want to actually move? We've got our bank account that we have. We can start typing it in. Let's say if we start forgetting what that looks like, we have the smart search that tells us, okay, well, this is the bank account that you had. That actually ties into this particular ID number. Now we've got the bank account that we wanted to pull up. You can pull up different payment methods. So within this particular ID, what types of transfers do you want to make? Do you want to make a bank transfer, credit transfer, a check to the different banks? You can select on those. Let's just say we're going to do $500,000 for our monthly bonus. What's going to take place here is, now that we've set all this up, you're also going to have approvals that'll take place. You can go in and make approves. But this is going to initiate a new bank transfer from the original account that we went all the way from our high-level cash position down into that particular bank cash flow analyzer. And now we're moving those funds. Oh, here's the enter currency. Now we're moving those funds into another bank account. When we actually go back to our cash position, from that graph in real time, we're actually going to be able to see what that's going to look like. So we've still got our same $3.7 billion in cash flow, but when we actually drill in and take a look by our bank, we now have $1.7 million in our Citibank instead of the 1.35 or something that we had in there before.
And this is real-time reporting, right, Sarah?
Correct. So I didn't have to make any adjustments. I didn't have to do anything. As soon as you make any changes within the system, it's automatically going to show up here in our analytics. Another thing we can do is you can monitor all the payments. So you can see any payments out there by particular dates. We have one here, now 48, the one we just made for $500,000. You can see the document number, when it was made. There's the time, date, and user stamp on anything that was out there. You'll notice for this to actually be initiated, there are some approvers that need to take place. So it could be one of any 4 of these approvers that are out there, but it shows who created it, when, and then you can drill into the actual details. So the bank accounts that you had, where the house bank came from, what the actual payment document was, for you to be able to see all of these areas. You'll also notice that I got a notification saying I've got something that needs approval for me to be able to go forward on these particular items. All right. Julio, that kind of wraps it up for our quick walkthrough of bank management and cash management. I will pass the torch back over to you.
Thank you very much, Sarah. That was very informative, and it just shows the power of the tool, because CFOs, controllers, CAOs, treasury professionals, what everybody's looking for right now is timely visibility. So visibility in the sense that, especially if you have a number of bank accounts, most large organizations or even small ones do, they want to see those accounts in real time. So that's why I asked you that question. Can you see the changes happening real time? Because sometimes if the changes happen real time, other people in other subsidiaries may be making commitment decisions based on incorrect, outdated information. So that's actually a very key part of it. And Sarah, I actually have one more question. I have to put on my accounting hat now. Does the tool actually do bank reconciliations as well?
It does, yeah. So we didn't get too much into it, but there's also a way to manage your bank statements as they come through, so you can do reconciliations against what you have. You can also see some of those other pieces as well.
Thank you very much. So moving on, we're continuing along our Treasury overview journey. We just talked about cash management. Now we're going to jump into cash forecasting. So as I was saying before, you find a trend now, especially in large Fortune 500 organizations, is that a lot of CEOs, as well as CFOs, they're actually rated on how well they manage their working capital. Working capital is really the lifeblood of a company, so you can see how important it is. I know a number of colleagues I used to work with, their bonus was dependent not only on how much they grew their revenue base, but also how well they manage their cash. So this takes us into the cash forecasting. Really, cash forecasts, they're really a tool for senior management. Why? Because they're developing financial strategies. But also from a treasury perspective, they're also ensuring that controls are operating effectively. So what are some of the trends that you see? So items like operating receipts, payroll, taxes, interest, they follow distinct patterns and can be specifically forecast. There's also deviations from forecasted amounts that indicate a breakdown in process or operational issues. This takes us to the whole point of predictive accounting in the S4 environment, where you can essentially forecast out what does my cash needs look like, what does my inflows look like, and say, okay, this is my cash forecast using intelligent automation. There's also forecasting for significant non-operating cash flows. You know, a lot of companies, they go through acquisitions, divestitures, have to pay dividends, debt borrowings. These things are very important, and usually they have to require board attention. So these transactions generally require special approvals. In my old job before Bramisol, we used to have a CapEx forecast, then we would have a non-operating cash flow forecast. So was the company planning to do any sort of major acquisitions? Well, usually you have to fund those acquisitions, or you have to fund large CapEx purchases. So beyond your regular day-to-day running of the business, paying my payroll, paying my regular vendors, you also have a special forecast, a special budget for these non-recurring items. So that's very important, especially if you are in a mergers and acquisitions mode where you're buying companies or you are investing within a new area. There's a lot of investment activities being undertaken. So therefore, cash forecasting comes really into play in that environment. The last piece is really capital planning. You obviously need to have a lot of cash on hand to be sufficient to address those companies' needs. So having a proper cash forecast is of critical importance. Now we're going to move into, we talked about cash, we talked about cash forecasting. Now we're moving into debt management activities. Unfortunately, many companies don't have enough cash on hand from generation of the operational funds, so they have to go out into the market or go to banks and borrow. So this is basically a coordination issuance of debt in public markets. What does that require? It requires collaboration between underwriters, internal, external counsel, your external auditors, as well as your internal accounting team. The thing we have to take into consideration is it's just not relevant to a company's accounting policies and procedures. But when you go to public markets to get debt, you also have to comply with the SEC regulations, which could be very complex depending on what type of instrument you're actually applying to obtain. So what are we trying to ensure here? We're trying to ensure that we have proper principal and interest, that they're paid timely. You never want to miss a debt payment. You want to make sure that there's proper compliance function within that debt management function. What does that mean? That means that every month or every quarter, a lot of companies with debt in their organizations have to do compliance covenants. They have to make sure that their debt to equity is within a certain ratio. And then a lot of companies also have to forecast interest expense. A lot of companies measure their performance by using EBITDA. Well, EBITDA, you need to forecast your interest expense as you go ahead in your forecasting activities. And then lastly, you really have to monitor the credit creation activities. So who exactly is creating the credit notes? Who is actually creating the applications? Is that a treasury function? Is that an accounting function? Is that a combination of both? So we go into the risk now in debt management. So you incur incremental debt. They can have significant consequences to the company's financial position, the liquidity, and the results of operations. Why? Because the more debt you take, the higher your leverage ratios. A lot of companies have to comply with certain leverage ratios. So if you have a higher leverage ratio, it could be detrimental to your company's credit rating or compliance with those credit and operating agreements. Also, you hear about a lot of companies with a lot of significantly higher interest costs. Interest cost is usually paid first because that is actually funding the company. So you have to be careful about your interest load. So what is a mitigation strategy? Usually for debt execution, you would limit that only to a few individuals. So CFO, treasury, executive levels, and probably with a compensating control of having the CEO actually sign off. Significant borrowing decisions are usually initiated by management, but must be approved by the board of directors. So what are we trying to ensure? We're trying to ensure that there are clear guidelines within your organization about incurring additional debt. You want to confirm compliance within those guidelines, and you want to make sure that your compliance covenant is assessed on a timely basis, usually monthly in my experience. The next thing we want to talk about is The terms of the debt arrangements can vary significantly. Maturity and interest rates may not tell the full story. It gets back to the accounting. How do you account for these various instruments? So you may have a balance sheet classification, related disclosures. In the accounting world today, a lot of finance professionals have to deal with mezzanine debt. Mezzanine debt is actually debt that is not equity, it's not debt, but it sits in between equity and liability. And from an accounting perspective, you have to go through a lot of documentation to conclude and prove to your auditors that this debt, it looks like debt, but it's actually equity, and vice versa. This equity instrument, like preferred stock, is actually, it looks like equity, but has a lot of debt features. That will encourage your auditors to look at this thing very significantly, because obviously it depends. If you conclude that an equity instrument is actually debt, it's going to negatively impact your leverage ratios. So what do we try to do here? We try to regularly communicate between Treasury, accounting, and reporting. And you always want to have a review of relevant debt agreements in advance of the execution of it by legal especially, and obviously accounting. So what you're looking for is you're trying to review agreements looking for security requirements, things that can make debt payable on demand. So if you miss your interest payment, a lot of this debt becomes callable immediately. And then when are the interest rates being reset? Are there any covenants in place? Some covenants relate to inventory, some covenants relate to cash on hand, some covenants relate to you're not allowed to take on additional debt. So communication between your subsidiaries as well, because that takes into consideration debt as well, is critical. That brings us into covenant compliance. Treasury is generally responsible for reporting companies are in compliance with the covenants. And every month, as a former accountant myself, I would have to make sure that the calculations being done are correct, that the calculation of the covenants therefore requires a thorough understanding of not only the operating results of the company, but the debt agreements. Debt agreements are very, very specific on what numbers to pull. Are they using EBITDA? Are they using EBIT? Are they using net income? And then the accounting team will take those agreements and layer it on to the actual company's results. So with that said, you must determine how to align the agreement terms with their company's records. So a lot of companies get confused because the agreement says we're going to use EBIT and they're using EBITDA. Big difference in results. So we always recommend that the preparer, the accounting team or treasury team, should have thorough knowledge of the company's application of GAAP, because it's not just about the accounting, it's about how that individual company applies the accounting. Financial covenants are usually tied to GAAP as a specific reference date. So did you meet your compliance requirements as of December 31st, 2018? And that changes every month. Some companies have to report monthly, some companies have to report annually, some companies have to report quarterly. So this takes you to what can be done by the Treasury organization to ensure compliance. It really boils down to looking at your subsidiary covenant compliance should be considered by cross default, provides existing subsidiaries are all in compliance. In my experience personally, I used to work for a subsidiary. Every month I had to sign my name on a compliance certificate that said I was in compliance with the overall company's debt agreements. And they should always get representations, like I just talked about, from your subsidiaries that you're indicating compliance. Also too, Treasury should be informed of potential cross-default exposures. So in my experience, especially in a multinational environment, I've seen situations where you have a CFO in another subsidiary outside of the parent, where essentially he or she is actually borrowing local funds to fund the local subsidiary's operations. Unbeknownst to him or her, the parent company has taken out additional debt. And what happens? On a consolidated level, because the parent has taken out new debt, as well as that subsidiary additional loans, the company broke its covenant compliance. Needless to say, the gentleman is no longer around at the company, but it just shows the importance of proper communication. And we talked about the theme of this is really timeliness in reporting, because without information knowing, okay, my parent company in North America has taken on additional debt. Maybe me as a subsidiary CFO, I'm not going to do additional borrowings because it may trip up my compliance with the overall debt to equity ratios. Very important. Now we're going to get into the crux of risk management for treasury activities. This is where it really becomes very complex. This is where you get into derivatives. This is where you get into hedge positions. So there's three broad categories of risk management activities, which we incorporated into a treasury organization responsibilities. First one is interest rates. The second one is foreign currency, FX changes. And the last one, if a company is involved in it, is commodity arrangements. So the scope of work managed by a treasury function can really vary significantly. But some of the following are examples of some of the key tasks that the Treasury Department will actually participate in. So you will have some evaluation of the risk and management recommendations for risk mitigation strategies. Some of you are going to negotiate the ISDA agreements, which is the Swap and Derivatives Association. They are standard agreements. And what about the counter risk considerations? You always have to wonder, when you take a hedge position, who's on the other side? Who is the counterparty? Are they going to be around when the hedge is over? Are they going to be able to pay up if need be? And then you have to ask yourself, who is executing the trades? Is it a banking association? Is it a banking organization? And then obviously somebody in Treasury and sometimes the accounting group is going to be wanting to monitor the trade values and the effectiveness. When you start talking about derivatives, you start getting deep into the complexities of hedge accounting. Hedge accounting, you have to always look at, if I take a trade position or a hedge position, is that being mitigated effectively? Because the impact is, from an accounting perspective, the ineffective portion goes directly to my profit and loss statement. I wanted to bring in Haresh to give his take now on what have you been seeing on the automation for dealing with the more complex areas of derivatives and hedging. Haresh?
Sure. SAP works with many large companies in the world, and majority of these companies are exposed to the risks that you were describing earlier. So most of the companies, struggle primarily. If I have to list down two or three things, primarily they struggle with identifying and quantifying the exposures that exist in their enterprise. So being able to, number one, locate the exposures, summarize them, and be able to understand what those are is a very important aspect of this process. They also want to, as you said, if they are involved in hedge accounting, they want to have processes that are pretty straightforward and seamless from operations perspective. They want automation. When they want to analyze these derivatives and the exposure positions, they want to have ways to look at a summary as well as be able to drill down and capture some details behind it. So in a nutshell, exposure management, trades, and analytics. These are the three major areas where companies are looking for solutions.
Thank you very much, Haresh. And thinking about the next step is really thinking about risk mitigation strategies, which you already think about. We need to have complexities in derivatives. They're very complex areas. You want to make sure that you have in-house expertise. If you don't have in-house expertise, you would go outside to get the proper level of guidance from derivatives and hedging. Lastly, talking about the risk management challenges, you want to make sure, like Haresh was saying, is that your derivatives are structured properly. You want to have proper integration of risk assessment. And then lastly, you want to keep up to date with the constant changing of the rules. That takes us to the last slide here before I introduce Haresh to go over the SAP solutions. Is basically, there was an article yesterday that says Warren Buffett blames Gap for rule loss of $25 billion. That was a change that happened a couple of years ago, where now his investment in his equity companies have to do mark-to-market accounting. So any fluctuation in the prices of those equities have to be directly goes to the income statement. So this shows that accounting changes do impact companies every day, especially for the Warren Buffett group of companies for $25 billion. I'll now turn it over to Haresh, who is going to give an overview of some of the treasury solutions from SAP. Haresh?
Sure. Thank you, Julio. So I know there's a lot on this page. I'll be very brief here. The role of treasury, as it evolves, companies are looking to have an integrated solution that offers capabilities for high-level analytics and reporting, for operating in a way that the processes work seamlessly across the enterprise, and they also want to work with their partners. And in treasury environment, there's a lot of partners. As you see here at the center, the digital core is where SAP's core treasury solutions reside, which include payments, cash management, debt and investment management, and financial risk management. Surrounding this central core are all the different parties that a treasury system typically interacts with. For example, trading platforms for executing the trades. If they're hedging risk originating from FX or interest rate, they would need to trade these transactions on our trading portal. If you look at the bottom left section here, market data, to be able to value these transactions, to do mark-to-market valuation, they need data on a regular basis. That means they need to have integration with market data providers. On the right side, if you go center right, you can see SAP Multi-Bank Connectivity is also listed there. A lot of these transactions, when they settle, they go through a payment mechanism. Customers need to have a seamless way to exchange these messages with their banks and execute these settlement transactions. Of course, it doesn't limit to just the risk management activity. Companies also need to be able to connect with their banks for pretty much all their payables and receivables transactions, receivables in the case when they have direct debits and so on. And of course, as we saw in the cash management demo, the cash position cannot be developed unless you receive the statements, account statements from your bank. So a lot of these activities are very closely knit with the processes that occur outside of the SAP's core solutions. And the companies that we work with are desperate to have solutions in these areas. And SAP particularly caters to this whole ecosystem approach that our customers are looking for. And all of that is on display here on the screen, how the core solutions are integrating with the whole ecosystem components in there. Can we go to the next page, please?
Yes, sir.
So the philosophy that SAP has adopted, which is to offer, number one, visibility and insights from the treasurer's dashboard. These dashboards are graphical in nature, which allow extensive drill downs to get details for analysis. Number two, it offers controls of treasury processes through automation. So there's a lot of automation being introduced in a variety of places. One example could be, automatically receiving the trades that you execute in your trading portal into SAP and managing it throughout the life cycle. And number three, to maintain business integrity and compliance. And some of the things that were talked in the past about how companies can comply to their own policies as well as to the regulatory requirements is also a part of the solution set offered by SAP. Next slide, please. And last but not the least, to comply to these requirements, you can see on the left side there are various risks that a treasury organization and a company as a whole is exposed to. And if you take a holistic approach, you can benefit from a lot of the different capabilities offered by the governance, risk, and control GRC set of solutions, which are also tied to treasury solutions in a seamless fashion. So essentially, you're basically addressing the three pillars of the philosophy, which is visibility, automation, and control.
Thank you. Thank you very much, Haresh. We really appreciate your insight and taking time out of your busy schedule to go over all this good stuff with us. We definitely will be talking to you very soon. We've come to the end of the webinar, and I want to thank Haresh again from SAP, Sarah Thompson, and Steve Stone. And if you need to contact us, you can go to brahmasol.com. You can also find us on Facebook and LinkedIn as well. Thank you, everybody. We are 2 minutes over. Have a great day, and thank you very much for joining the webinar today.